Hello and welcome once again to the Smart Money, Dumb Money Show, and I am your host, Keith Richards. I'm the President and Chief Portfolio Manager of Value Fund Wealth Management, and I'm a technical analyst. And today, we're going to go back to some basics. If you've taken my online trading course, and I do strongly recommend that you take it if you have not, it's just a few $100. I think it's about $390, and it's the best $390 that you will ever spend. People waste thousands, tens of thousands of dollars on holding stocks for too long, buying them at the wrong time, or placing money into the stock market, or listening to the buy and hold propagators, and yet won't spend a couple of $100 on teaching themselves to stop doing those terrible habits and stop losing so much money. My course helps you avoid those mistakes, and I've literally put everything you need to know to be a far more effective trader into that course. It's a brainchild that I came up with about a year ago, and I think it's the most important work that I have ever done. So I've priced it very, very low so you can access it. And if you are a do-it-yourself investor, you need to take this course, full stop. Anyhow, if you've taken the course, and many of you have who are watching this video, you will remember that near the beginning of the course, I talk about the basics, which is the 4 phases of the stock market. So we're going to do a little bit of a deep dive on that today, and we're going to go right to a PowerPoint where I've put together some slides that will kind of illustrate how we identify these phases. Now, again, you need to take my course because this is a 10-minute video, and I'm going to be talking just the highlights. So let's get started. There's 4 phases of the market. Really, what you could call them is a basing phase, and then an uptrend and a downtrend filled in with a topping phase. So these phases occur in the markets because of human psychology. People think that, well, with all the computerized trading and all these different things, that things are different these days, the news flow, etc. It's true, things move much faster than they used to move. But despite the computerized trading, they move on second by second trades. They're not interfering with the longer term trends, which always comes down to the big money managers and retail investors and how they're moving within the grander trends. So don't get all tied up over some of the new program trading and stuff that you'll hear about. Yes, the program trading messes with your intraday pricing and sometimes gives you a lousy fill on your buy and your sell because they're messing with you during the day. But the longer term trends are dictated by human emotion. So these phases represent the phases of human emotion. So let's look at that. Now, this is a diagram that came from sentimenttrader.com. Now, you'll notice that their diagram shows 1, 2, 3, 4 in here, but I'm relabeling the diagram to move within the psychology phases of market trend. So there is a bottom where market confidence is starting to return, and then an uptrend, enthusiasm, and then there's usually some sort of a top and a panic. It moves down, and then you move into the full-on downtrend. That's the discouragement phase. Where are we right now? I believe we're in the discouragement phase. I've talked about that on a blog just recently, and I suggest you rifle through some of my very recent blogs, and you'll see notations on this. But let's take a look at some of the indicators that can help us identify what phase we're in. And the most important indicator, of course, is always going to be the trend. So this is a long-term chart. This is going way back to 1990. I want to really focus on the past two major bear markets. And you can see that there was a topping phase, phase three, there was a downtrend, there was a base after the 2000 to 2002 market bear. And that base was illustrated by a sideways consolidation period, but I want you to look at something else. You see this candle right here, it's got a long wick on it. That's got a hammer, and the hammer is a sign of a capitulation. So the capitulation hammers, we got a couple of them. There was one here in early, probably around March, April of 02, and then there was another one during the summer. And there was even a final one that marked the actual bottom early 03. So you're looking for long wicks, and that is coinciding with sentiment and momentum capitulation, which we're going to look at in a minute. But I want you to get a handle on that this pattern repeats over and over again. And you can see long candles mark the bottom, long candle wicks, because they're washouts and the market turns around. And that always happens at the bottom of bear markets. Now, 2020, some people call that a bear market. I'm never sure if I should call it that, because as you can see, you remember the old Sesame Street song, one of these things does not look like the other. Well, it's hard to say that that was a bear market. It was fairly deep, and it had the washout candle that I'm looking for, that long wick intraday reversal. I believe that was March of 20, or April it might have been. But otherwise, you didn't get these steps of recoveries followed by sell-offs that you get in traditional bear markets like we had in the 2001 to 2 and 2008 to 9 bear markets. Here, we are getting those steps down. You'll notice we're not getting any washout candles. And it's not as deep and as built yet as the previous two bears. Now, it doesn't mean that we get another bear that looked like the first two. I mentioned in that blog that no two bears are alike. You can't say, well, it'll look like this and therefore it's going to look like that again. It's going to resemble, but not absolutely mirror what has happened in the past. So how do we tell? We are probably in phase 4. We're in a bear market where we're in a downtrend. Anybody that wants to argue with me on that, I think I'll win that argument. And I don't think any of you are willing to argue that we're not in a downtrend. We're below the 200-day moving average. We're making lower highs and lower lows. What more do you want? We're in a downtrend. The question is, when does phase 1 come in? Now, we haven't seen that candle yet where you get the big long wick. So that's one piece of evidence that we're not there yet. Let's look at another piece of evidence that may be encouraging, but we need to see all the ducks line up. So this is another type of indicator that I look at, and it's an indicator that I tend to use for big picture analysis. It's the percentage of stocks that are above their 200-day moving averages in the S&P 500. Now, the S&P 500 has something like 510, 512 stocks. It's not actually just 500 stocks, but to keep it simple, it's about 500 stocks. And when the indicator's up here, that's 95 right there. So back in 2021, we had something well over 90% of stocks were above their 200-day moving average. Nothing could go wrong. The market was going up, and it was never going to go down again. That's the attitude during these phase 3 tops. They can last a while. You can see here during the mid 2011 to 15, just before the market fell apart into that late 15, early 16, the phase 3, sign of lots of stocks trading above their 200-day moving averages, it lasts a while. So it did last a reasonable period of time, this time again, but once again, it finally moved into a top and then a downtrend, phase 4 downtrend. The question is, are we at a level 1 washout yet? Well, remember, we just looked at the charts and we saw that we don't have that long wick candle. And we did get those long wick candles here And here, as we look, and even in 2020, we had that long wick candle. So it's pretty deep. The number of stocks below their 200-day moving average did reach around 12%, 12.5%. That's not a lot of stocks as a percentage of the S&P that were above their 200 days. So it was pretty washed out, and that is pretty close to the levels that we've seen in other bears. You get small spikes like this, but I'm looking for the deep ones. And, you know, it was pretty close to, say, the 02 washout, but it's to be seen if this is going to coincide with the washout day, which will be illustrated by a hammer or some sort of a candlestick that looks like that. So let's take a look at another piece of evidence. So we have a growing piece of evidence that the market is becoming despondent, and that's seen on the number of stocks below their 200-day moving averages. So let's take a look at a true sentiment indicator, and that is the VIX. Now, again, I'm just highlighting. You need to take my course to hear all of these indicators, and you might also want to pick up a copy of my latest book called Smart Money, Dumb Money, because I cover all kinds of sentiment indicators in that book. But I'm going to just focus on phase 3, which is the top, and phase 1, which is the bottoming process. You'll notice it's reversed here. The ones are at the top of this chart, and the 3s, which is actually the topping phase, are at the bottom. And that's because the VIX is a fear index. It represents the premiums that options traders are demanding on their options as they write them. So the more volatile the market is, i.e. the more it's going down, the more premium they want, because they don't want to be left hanging to dry and having to buy a stock off of you at a worse price than they wrote the option for. So I'm just circling the red the extremes, and you can see we go through these extremes. You see in 2000 and you know, the tech sell-off, you got at 2002, and even earlier than that, you got some kind of pessimistic washouts, and then a bottom, and on it goes. This is remember in 2016, people were very complacent coming into the 15-16, and then it washed out. And you can see the market, I didn't put a 1 here, but moved into an overly pessimistic period by early 16. So here we are. We saw an overly pessimistic period in 2020, and that lined up with the other things we just looked at, with that spike hammer formation and all that stuff. And then it moved into, you know, the bull phase 2, and then finally a period of complacency. Now, notice this period of complacency wasn't as deep as some of the others in 2021. Nevertheless, it was down there, and since then, the market has been moving down after that top. Remember, complacency is a topping period. So after that topping period, we've become more pessimistic about the market, and that shows up as the VIX moves higher and higher. But I want you to notice something. So we're calling that phase 4, which is the downtrend as pessimism grows. Okay, so what we are not seeing is a washout on the VIX like we have at the bottom of other bear markets. So we go back, yeah, we're getting some washout in the number of stocks that are trading above their moving average, but we're not getting a candlestick with a big washout stick, and we're not getting the VIX, which typically spikes way over 30, okay? And I mean like into the 45 plus area is typically the bottom of a true bear market. Now, again, no two bear markets are alike, but history shows us. If we go right back to 1990, so we're looking at well over 30 years of data here, and typically big bad bears like we're in now finish up with an ugly capitulation point. And that capitulation point can sometimes only last a day, like it did in 2016, and it did sorry, that was 2016, and it did in even 2020. There was a few days there where it stayed above 35, but there was one biggie where the VIX went quite high, as it did in the 09 March bottom. Okay, so we're not even near that yet. I mean, we see the VIX is high, but it's not at full-on capitulation. So bottom line in today's lesson, if you will, is that some of the signs are there. I like to say there are some signs of green shoots, as some market pundits like to say as well. So there's green shoots appearing because we have a washout look in the number of stocks that are below the moving average, but we're not there when we look at the chart formation yet. We're not seeing a washout candle. We're not even seeing a base where it moves sideways for a bit. And we're definitely not seeing a sentiment washout, at least according to the VIX. I can tell you we've not also seen a washout on many of the other indicators, including the put to call ratio and a few others that I talk about in my course and in my books. So bottom line, we're getting close. We are getting close because I'm seeing it on the market breadth indicators like the percentage of stocks over the 200-day and a few others, okay? But we're not there yet. When will we be there? Time will tell, but I don't think it's 6 months or a year from now. I think it's weeks to maybe a couple of months. Could even be less time than that, but it's not here as we speak. Thanks for watching. See you next time.